Insurance bad faith only exists when someone who buys an insurance policy or is covered by an insurance policy sues their own insurance company. That's called first-party insurance. And in Oklahoma, the law has a very high standard. It's sort of like if you were an athlete and you were a high jumper, anybody can jump over a 1-foot bar or a 2-foot bar. But bad faith, the law sets the bar 10 feet high. I mean, it's really high. You have to thoroughly investigate. You have to evaluate. You have to make a fair offer quickly. You don't have to do that in a normal car accident case where you're not the insured. And so that's where a lot of insurance companies get into trouble. So when you explain to the jury what the burden is for an insurance company treating their own insured, that makes it a different ballgame entirely. Mike Burrage and I tried a case together in 2008 that kind of exemplifies that. We were able to demonstrate that an insurance company had acted terribly to their insured, had basically taken a lot of money that should have been paid to the insured, and they made them fight like the devil to get it. We got a $130 million jury verdict in 2008 in Lawton, Oklahoma, and made a closing argument that lasted just a few minutes and got a punitive damage verdict of $30 million. That was definitely deserved, and the case settled after that. It was deserved because that company treated these people like an enemy, and the law requires the insurance companies to treat their own insureds in good faith and treat them fairly. And they didn't do that. And we were able to prove that. But again, you have to know the language. You have to be able to explain these duties and explain how they work in the real world. And a lot of people don't speak that insurance lingo. So we spent the first part of our career representing insurance companies. They basically sent us to school and taught us all that. I didn't learn that in law school. So that turned out to be a big advantage for us.